Welcome to another episode of the Riffle, a podcast series brought to you by 10 Leaves. Today we're diving into something really fascinating happening in Dubai's financial services world, specifically the Dubai International Financial Center, the DIFC. Growth there is just explosive. It's amazing. But the big question is, how do you manage that kind of speed? Hiring fast, new products, going global. How do you do that without, things going off the rails?
That's the core issue, isn't it? And our mission today is really to unpack a thematic review from the Dubai Financial Services Authority, the DFSA. They look closely at what they call high-growth firms. So you'll get some real insights into the amazing opportunities this kind of rapid expansion creates, but also the unique challenges and, crucially, how firms can actually navigate all this responsibly, sustainably.
Excellent. Think of it like a blueprint, maybe. Not just for firms in the DIFC, but really any company trying to walk that tightrope, growing fast in a regulated sector. We'll dig into those moments where you realize, oh, okay, smart regulation isn't actually a barrier. It can really support that growth. We're covering business strategy, governance, staffing risk, even down to client onboarding.
Yeah.
Okay, let's get into it. So let's start big picture. This DFSA review of high-growth firms. It wasn't just theory, right? It reflects this huge expansion actually happening on the ground in the DIFC. What are the numbers telling us?
Oh, the numbers are quite striking, really jump off the page. The total count of authorized firms there, up by about 46% since just 2021.
46%, wow.
Yeah. And just last year, 136 new firms got their authorization. Think about net profits, too, growing at roughly a 13% average rate each year since 2021. That hit $3.19 billion.
Okay.
And then you've got assets under advisory up about 16% annually, hitting $172 billion. Assets under management up around 10% annually to $169 billion. It paints a picture of real confidence, real activity.
Those are genuinely massive leaps. And it's not just the overall picture, is it? Specific sectors are booming, too. What does that tell us?
Absolutely. The review really highlighted significant growth in key areas. Brokerage firms, for example, they've increased by 40% since 2021. That's 63 firms now.
40%.
Right. Advisory and arranging firms up 48% to 194. And wealth management firms, this one's big, grew by 57% to 278 firms.
57%.
It suggests, very specific market demands are being met, niches being filled aggressively, and client numbers are surging too. Retail clients up an average of 72% annually.
72, that's incredible.
It really is. And employee numbers grew by 56% since 2021, up to 9,000 people. So it's broad, not just, isolated pockets.
These numbers are just, very compelling. It makes you ask, what's the secret sauce here? Why the DIFC? Why is it such a magnet for this kind of rapid growth?
Well, if you step back and look at the bigger picture, Dubai and the DIFC, they offer a really attractive proposition. It's centrally located, Middle East hub, great global transport links. That helps with working across time zones.
Makes sense.
Then there's the legal system. It's modern, common law-based. Huge infrastructure investment, lots of networking opportunities, a big, growing investor base, and a dynamic tax regime helps too, of course. The center itself now has over 900 regulated firms, employing more than 40,000 people. It's an ecosystem that's really designed to foster growth. And you see the DFSA's own business plan for 2025-2026 actively commits to strengthening that position further. It signals ongoing support.
So it's quite deliberate then, an intentional environment. How are firms actually, showing this ambition? What are the tangible signs on the ground?
Yeah, the review saw lots of concrete actions, firms hiring aggressively, moving into bigger, newer offices, pushing into new products and services, which naturally often meant they needed license upgrades from the DFSA. We even saw cases where firms transferred whole operations, senior executives included, directly from other major financial centers right into the DIFC.
Really? Like relocating entire teams?
Exactly. It shows this isn't just slow, organic growth. These are ambitious, deliberate plans being rolled out.
Okay, so growth is happening. It's fast. It's ambitious. But it can't just be about getting bigger, right? It has to be about growing smart. What does the DFSA expect from these firms, strategy and governance-wise, to make sure this growth is actually sustainable, not just a house of cards?
That's a really important question. The DFSA puts a lot of emphasis on the regulatory business plan, the RBP. It's expected to be a living document, essentially.
A living document, meaning?
Meaning it details current and forecast activities for the next 12 months. It has to show how risks are being managed effectively. And crucially, it needs to be updated whenever there's a material change. Firms also have to tell the DFSA immediately about any proposed big changes, restructurings, mergers, acquisitions, expansions, anything that could really impact their risk profile or their resources. For these high-growth firms, their strategy itself becomes a kind of dynamic risk management tool. It's about looking ahead, not just reporting after the fact.
So the plan needs to keep pace with the business itself. It can't be static. Where did some firms maybe stumble a bit with this, keeping the RBP dynamic enough?
Well, the review did note some instances where RBPs just weren't updated with enough detail about strategy shifts or the thinking behind those shifts. It was almost like the plan was a snapshot in time, not a rolling forecast.
I see.
And in one case, a firm actually forgot or omitted to tell a DFSA about plans to set up a whole other entity and how that would impact their existing DIFC operation.
Mm-hmm.
Yeah. That really goes against that core principle of being open and cooperative with the regulator. It highlights a gap where the growth strategy wasn't fully integrated with that regulatory transparency.
That makes total sense.
Yeah.
So flipping that, what does good look like here? What were the best practices for keeping that strategy both ambitious and compliant?
We saw some excellent examples, firms doing a full RBP review before they implemented any expansion. That included revising financials, staffing numbers, the works.
Proactive.
Very proactive. And reaching out to the DFSA early on for discussion, even for challenge, that was really encouraged and seemed very beneficial. Good firms focused on growth areas driven by actual client demand, real market opportunities. They were clearly aiming for profitability, sure, but also sustainability. And interestingly, many DIFC entities that were part of larger global groups showed real autonomy. They could tailor the group's global strategy for the local market here. That highlights their growing strategic importance within the bigger company.
That's a great point. Shows maturity. Okay, strategy is one piece, but it's only as good as the governance supporting it, right? Mm-hmm. How did firms make sure their decision-making structures could actually handle this pace rather than getting in the way?
Right. Fundamentally, the governing body, the board, usually sets and approves the business objectives. And management information, or MI, that critical data managers use is absolutely key for overseeing the business and those expansion risks.
Got it.
Now, growth was being discussed at board or committee levels, but there were some areas needing improvement, like some firms didn't really have a clear strategy after dropping a product that didn't work out, or they tried to expand their license scope too quickly without a proper, fast approach.
Rushing it.
Exactly. And sometimes the board minute, the written record of the meeting just lacked sufficient depth. They didn't really show enough evidence of proper discussion of challenge around the proposed strategies and the associated risks.
So it's not just having the meeting, it's the quality of the debate, the challenge function.
Precisely. That depth of challenge in the boardroom really reflects how robust the strategy is.
So what were the successful approaches? How did firms effectively tackle those governance challenges? What did the best look like?
Good practices definitely include strengthening those structures, maybe appointing new senior executive officers, revising the board's terms of reference, or even setting up new committees like specific audit and risk committees just to focus on managing the expansion.
Makes sense. Dedicated focus.
Yeah. One firm actually treated getting a license upgrade like a formal project. They set up a dedicated working group with people from business, finance, compliance, risk, legal, ops, tech, everyone involved, making sure all angles were covered.
Very thorough.
Very. Another smart approach was consolidating a new business line for a while, letting it settle, mature, stabilize before pushing for more growth. That kind of smart, incremental approach.
Okay, let's shift gears a bit. Let's talk about the human engine behind all this growth. Staffing, compliance, risk management. This feels like where the rubber really meets the road when things accelerate, doesn't it?
Yeah.
How do firms keep their internal controls from lagging behind?
They absolutely have to. It's critical. The DFSA is very clear. Firms must maintain adequate and competent resources. That means people and systems. Compliance functions specifically need to be properly resourced, staffed by capable people, and crucially have unrestricted access to senior management and all the records they need. As firms grow, it's just vital they keep asking themselves, do we need more support here? Compliance can't be an afterthought. It has to be seen as an integral partner in that growth journey.
Right, proactive resourcing, not just reacting when something goes wrong.
Yeah.
Were there cases where firms, where they fell short here, where the people side became a bottleneck?
Yes, unfortunately there were. In one quite concerning case, a former compliance officer had explicitly flagged the need for more resources. They had new products coming online, including crypto stuff. But the senior executive officer apparently had no plans to increase the compliance headcount. That's a major red flag.
Definitely.
Other firms seemed more reactive in their hiring. Compliance resources stayed flat even while the business was expanding significantly. They were sort of waiting for license upgrades to clear before even considering adding more compliance staff.
Playing catch up.
Exactly. And compliance wasn't always brought into those business-led growth discussions early enough. Sometimes specific compliance or internal audit work focused on the growth plans was just overlooked. It shows how easily growth can outpace the controls if you're not careful.
That's a classic trap, isn't it? Waiting until you're already behind the curve.
Sure.
So what does good look like? How did firms manage resourcing and compliance well, proactively?
Well, the good practices really stood out. Firms proactively identifying risks, maybe implementing a detailed risk taxonomy for new products, thinking carefully about employee conduct risks, which can often get overlooked during rapid expansion.
Good point.
Many use that incremental approach for new offerings, soft launches, lots of testing, multiple feedback loops. Smart. And crucially, most firms did expand their compliance resources or they brought the function fully in-house. They recognized that need for dedicated, on-the-ground support. One firm even embedded compliance resource planning right into their main business planning. They had a matrix to calculate the right ratio of compliance pros to relationship managers.
That's quite sophisticated.
It is. Another great example, pre-joining reviews for brokers being transferred in. Compliance would check their past communications, client classifications, KYC documents against the main group database before they started. Very diligent.
That makes sense, catching potential issues early. Okay, so beyond the compliance function itself, how did firms handle their broader risk management frameworks during this growth phase? Did those frameworks evolve alongside the business?
That's the key question, isn't it? Does risk management keep pace? Generally, the review didn't find major systemic concerns here, which is positive news. However, one area for improvement flagged was making sure the risk officer is involved right from the start in discussions about any new financial service offerings, not just brought in later.
Early engagement again?
Exactly. Good practice involved firms actively engaging their risk function to identify inherent risks from day one, expanding the risk teams as needed, and even developing educational materials to try and embed that everyone is a risk manager culture throughout the firm.
So decentralizing it a bit, not just a siloed function.
Precisely. Making it part of everyone's job.
Okay, so let's connect all this to the bottom line and client trust.
Yeah.
What about financial resources and client onboarding? How did those areas fare?
Well, financially, firms are expected to manage their resources very carefully. Thinking about diversifying revenue across different products, customers, maybe even regions, they absolutely must have solid procedures to review and manage their ongoing capital and liquidity needs, tracking cash flows, liquidity levels diligently, relying on group support, if that's applicable. And those frameworks we mentioned, the internal risk assessment process, IRLP, and the internal capital adequacy assessment process, ICARD, they're vital here.
Right, the IAP and ICAPI.
Yes. Especially for stress testing, what happens if growth is even faster than expected, what happens in a sharp downturn, those scenarios need to be considered.
Were there specific financial pressures that came up for these fast-growing firms? Maybe unexpected costs of scaling?
A subset of firms did mention pressure on their profit margins, yeah, and a high cost-to-income ratio. Often, this came down to the higher cost of hiring talent in such a competitive, booming market, especially for the newer firms.
Right, war for talent.
Exactly. It just highlights that growth, while obviously desirable, isn't always cheap. But the good practice showed finance officers were deeply involved right from the budgeting stage. They were monitoring the MI closely, proactively discussing potential financial risks, making sure there was enough budget allocated for hiring, and all the other costs associated with growth. It's about being realistic about the investment needed.
Makes sense. Financial realism. Okay, finally, let's touch on client onboarding, that first critical interaction. What did the review find there, especially with firms growing so quickly?
Interestingly, client onboarding seemed to be an area where firms generally were performing quite well.
Oh, really? That's surprising, maybe.
Well, perhaps it's because firms have learned lessons from past regulatory crackdowns in areas like anti-money laundering, AML.
Ah, okay. Learning from history.
It seems like it. It suggests these high-growth firms in the DIFC have likely invested proactively in strong onboarding processes right from the start. They recognize how fundamental it is for client trust and just basic regulatory compliance. The DFSA expects, solid client agreements, correct client classification, proper suitability assessments, the basics done well. But what we did see were some quite innovative approaches emerging.
Okay, intriguing. Tell us about those cutting-edge practices in onboarding.
Yeah, some interesting stuff. We saw firms putting in place quality assurance programs to ensure client information was consistent right across the board. And one firm, this is really forward-thinking, was actually investigating using a generative AI system for parts of its client onboarding process.
Wow, AI in onboarding.
Right. Truly innovative. Other examples were maybe more standard, but still important. Sophisticated updates to the onboarding questions, the knowledge checks, tougher appropriateness tests, beefed up AML and customer risk assessment forms. Some firms were also proactively reviewing their client base and actually offboarding inactive clients through a dedicated committee, streamlining things, reducing that dormant risk.
Smart. Tidying up the books.
Exactly. But the main message here is clear. Robust onboarding processes that are continuously reviewed and improved are just vital, especially when you remember the historical problems, the really costly fixes firms faced when their control frameworks didn't scale properly with growth, particularly around AML and counterterrorism financing.
This has been a really comprehensive look at what it takes to be a successful high-growth firm in the DIFC. It seems clear that while the opportunities are huge and the pace is exciting, sustainable success really boils down to meticulous planning, strong governance, being proactive about risk, and making sure everything people, tech, processes keeps pace with that expansion.
Absolutely. The DFSA's review really underlines that growth isn't just about speed. It's got to be about control, about resilience too. And the good practices they identified offer a pretty clear roadmap for firms looking to thrive. It really shows that good regulation isn't a barrier. It can actually be the foundation, the framework that enables a dynamic and stable financial hub.
So the big question for you listening is, as the financial world keeps changing so fast, how will firms strike that balance? That balance between the allure of rapid growth and the absolute need for strong, adaptable internal controls. And thinking ahead, what new risks might something like AI introduce if it's not managed properly within a growth plan? But also, what innovative solutions might it unlock? Lots to think about.
This deep dive has been brought to you by 10 Leaves as part of the Riffle podcast series. Thank you so much for joining us. Until next time, keep learning, keep questioning, and keep diving deep.